Hi guys, and welcome to the Knox podcast. Today I am here with Adam, one of our senior property consultants here at Knox. And we're just going to have a chat about the best investment classes that we have here in the UK and that we also have here at Knox to offer.
Yeah, I think, we've been a 20-year-old company. It's our anniversary this year.
It is.
And, we've moved with the times. We've started in the obvious markets, the residential market that's been prominent for, decades now, to say the least. And then, the student market was something that came in 15 years ago, for the type of property that we'll do, which we'll discuss. But, we want to discuss that overall. And then we've moved, the property market's change and evolve all the time.
Yeah.
And, we've kind of gone with that. And there's a couple of new areas which do stand out and are worth also discussing today, as well as obviously those core markets, which I guess is what everybody approaches first, particularly as a first-time investor. Yeah,
and the core probably being, the main one obviously residential. That one's been around for donkey's years, hasn't it? Everybody likes the old buy-to-let model.
Yeah.
And then I think you mentioned student as well. The student market's changed quite drastically over the last probably 10 years, hasn't it?
Yeah.
Into more kind of luxury, high-end developments. Some of the facilities in some of these developments.
Oh, yeah. When I was a student, 20-odd years ago, I stayed in, I wouldn't even like to describe what I stayed in, but it was barely worth livable, and there were, it was an old house. It was a bit of a wreck, and then it was more of a wreck when we were finished with it. But, now as students' expectations and also, what you can purchase for a student now is a modern apartment. It's not too dissimilar to the residential stuff that we have out there now.
No, you're right. And like I said, the facilities that you get. I actually didn't go to university. You mentioned obviously you did, but when my sister went to university, I visited her a couple of times. And what you get now compared to what she had then is just night and day. They've got cinema rooms, they've got roof terraces, state-of-the-art gyms and things like that. And then the apartments themselves are very nice studio apartments.
Yeah. And I would say with that I kind of think how it's evolved is that previous to that it was the HMO market. That was how investors in the 70s, 80s predominantly let to students. It was a house that you'd convert into 5-6 rooms depending on its size. And it worked very well, and you still can today get very high yields off that kind of property. People
still do them, don't they?
But a couple of things have come into play. The restrictions to a HMO landlord are, there's certainly more red tape that they need to go through now.
Lots of legislations and stuff, isn't there? Yeah.
Amendments to the property, added safety features, and I guess with that, it's a lot of management. I've got clients who have HMOs and they get big returns. I'll always say that. It's not something we openly do a lot, is it?
No.
But you've got to put the graft into them. Unless you've got the time and the effort to do them, then equally, that return can equally be, as good as it can be.
It's
a challenge compared to the amount of work you've got to put in. And I guess what we do is the opposite with that. And like I said, there's no wrong or right answer. Every investor's different. But I think with our model, it's completely hands-free.
Yeah.
And, you're getting a property basically that you never even get a phone call about it, do you?
Well, exactly, and that's what a lot of people want nowadays. I think the hassle and the headache of investing into property has worn thin a little bit with investors and people who do have the cash to invest. Often are busy individuals, not business owners. They've got other things to be doing with their time than visiting properties, dealing with tenants or students. They're all fully managed, aren't they?
Yeah.
So we've got lots of clients overseas, haven't we? What is it, maybe 35, 40%
nearly
overseas?
40% now,
Yeah, so they don't even have to come to the country.
No.
So it provides them with a good investment, yeah?
Yeah, and I guess you got the other, an older property. Like I don't want to be doing comparisons to HMOs because, like I said, they are an effective way to invest, but it's an older property, and I guess with you buying something brand new, you've got all the warranties, guarantees, even down to the appliances. So, like you say, a lot of our clients who are busy individuals, if you haven't got the time to do the HMO, if you have, then certainly explore it. But if you haven't, and you want into something that's everything from cost effective in terms of running the property, maintenance, then a modern apartment puts all those ticks in the box. And quite often, this a young student wants that kind of modern living with the gym
yeah.
downstairs.
That's what they expect now. It is what they expect.
Oh
yeah.
I've got all this to come when my my children grow up, and that's going to be a shock. I mean, what they're going to be like then? They're going to have like 6 car parks outside.
There'll be 3-bedroom apartments. Penthouse views.
And I'm paying for it.
Yeah, you're paying
fantastic.
for it. Yeah. And how many kids have you got?
I've got 2.
Yeah, 2. So you're gonna have to get 2
double
lots
the
of
cost.
them. Yeah.
Yeah, so that'll look like I say. Yeah, I'll have to work a bit busy. Well, my wife has me working busy anyway, but I'll have to continue for a long time now. But it is a model that's consistent because every September you pick out your Manchesters, your Birminghams, the major cities. You've got student populations of 30,000. Stoke, that's not the one that comes to mind, but it's a big market. You've got Manchester, 90, 100,000.
Yeah.
Liverpool, I think 60, 70,000 students. Regardless of an economy and where it sits, those students arrive every September in those kind of numbers.
Always got demand. Always
arrives there. If one thing that every client says to me, and it's the worry that first thing you can worry about or be concerned about is, am I going to always have a tenant? Yes. And if you're going to have that numbers of potential tenants coming into that city every year, it's a pretty solid market to get.
It's not a concern to have in terms of having void periods and things like that. And they also sign 51-week tenancies, don't they now? So it's not like they stay there for 3 months, disappear for another 3 months to go and study for their exams and come back to take the exams. They've signed a 51-week tenancy. You're getting paid for 51 weeks of the year. The management company takes a week to turn the apartment around, clean it, and move the new student in. That's so you've got that security and sustainability. And they often come with rental assurances, circa 7 up to 10% net now we're seeing, aren't we? So it's certainly a strong market. Yeah,
I met a client this morning at our Manchester project, and they could see it from both sides because they bought a property and they came to see kind of it's going to be finished in the summer, so they came to see a show apartment there. So they were the investor side of it, they were the apartment owner, but they mentioned they've got a child at university in Birmingham. I can't remember where it is, but they're seeing the other side of it, so they're paying the rent, which is £200 a week, and they said it's a very small studio. It doesn't have it's like a communal kitchen one. So they've got communal features. It's a straightforward bedroom with a separate bathroom, and they're paying £200 a week. So they kind of say, look, I kind of bought this because I'm on the other side of the coin here. I'm paying £200 to the apartment owner of the property my child stays in. So I can see fruitfully how the returns work backwards that way. So you can kind of see how the yields work very well against the prices that you're paying for these properties, because people think the yields are maybe above. How does 8%? Is it realistic? How is it achieved?
But how do they afford that? That's the question I get asked a lot. Is how do these students pay for it?
Yeah, and it's bank of mum and dad and whatever. Additional grants. But you go on any kind of, I don't know, it could be a property portal or a student portal, looking at rent prices for students, and it makes your eyes water. They'll be £200 a week. They'll be £180 a week. That's the real world we're in now. Yeah. And when you're buying it under 100k, like most of them are, aren't they? Yeah, around that 100 mark, it's 8% returns.
Which is very strong in today's market. The residential market is 4 to 6. If you go a little bit further down south, it goes slightly lower. But we're typically seeing 4 to 6% net now, aren't we, in the residential market? You get much higher capital growth in the residential market than you would do in the student market, but the yields in the student market do outperform the residential market, and you're entering, like you just said, at a slightly lower price point, so it's more accessible as an investment to a wider audience, isn't it? So it depends what you want and what your bank account can handle, but
and I think that's kind of what we do here is property consultancy.
Yes.
And it's, we can send people lists of properties, like, every company works differently, but you've got to have an end goal about what you want to get out of that buy-to-let property or that property investment. And it's like you say, there isn't a one-shoe-fits-all model here. And that's why, we like to find out about what our clients' end goals are or what they want to achieve, because everybody doesn't go one garden path with that. It diverts off. If you want high rental income properties, appreciation, then you're going to go in different directions, which is what you touched on with the residential and the student. And at the same time, we paint everything, warts and all facts. Everything isn't rosy with any investment. It doesn't have to even be property, does it?
Of course. No,
anything.
No.
And, if we look at the student market, again, what's great about it, we've kind of discussed, but, let's hit things head on. You don't get the appreciation, do you, as you do in the residential market? Let's be frank about that.
No. And I think I speak to lots of clients who aren't necessarily clients, but people who inquire, and they want something watertight, bulletproof, 100% guaranteed, no downsides, no risk, and it just doesn't exist.
Yeah.
If that was the case, everybody would invest their money. Everybody would be making money from investments, but people's risk thresholds, if you like, are very different, and there are safe ways to play it. There are slightly riskier investments, aren't there? But I think you've got to be willing to look at the downsides, look at the pros, look at the cons, and then shoot for what you, like you say, what your individual goal is for that time period. It might be, I want to be out in 10 years, I made all my money back. It might be, I want this for the rest of my life. It might be, I want to pull some cash out, or just earn a steady income month in, month out. But that's what we're here for, isn't it? To kind of
and I think there's some great pointers that you touched on there. And I think again, going to that student model is they're a cash buy. They're nearly always a cash buy, and it's not our projects. But if you're looking at a studio apartment that's under 30 square meters, like I say, it's not our projects. It's just the way the model is. Anything under that size, you're going to go to your bank and they'll say, "Oh yeah, great, you can get a buy-to-let mortgage." And they'll say, "What you buying?" You'll be like, "I'm buying a 25 square meter studio." Crossing the box. So again, two things. It might be that you haven't got the cash to purchase at that price point. I couldn't right now. Or it could simply be that you might buy to pull money out, remortgage properties and move on. And again, it's not that property. So yes, you could buy it outright, but it's not a property you could pull money out of to then refinance and buy again. And again, that's where you'd move over to the residential market at that time. So it's those kind of things that, first of all, we're very upfront with, but also it's finding out what will work for you long term with the right portfolio.
From it,
The other thing with the student market is we touched on appreciation.
Yes.
And I worked this market maybe 7 or 8 years ago, going back to some of the earlier projects, and we used to have stuff at 35 grand. 35, 40 grand, and now entry level's about 80. So it's an appreciating market. That's seen. But if you see a market go up significantly over a 2 year, let's say your own house goes up 20% over 18 months or 2 years. You can't expect that property to go up the same value. Can you?
No. And that's not what they're there for, though. No. That's not what you're buying them for, and that's the point. And that's what, like you say, we are upfront and we are very open with clients about that, about managing their expectations, and you can't have it all.
You can't have it all.
Even though we'd all like to.
Well, I would like to.
Me too. Me too.
Doesn't always work out that way, but we wish every day, don't we?
No, we do. We do. But it's interesting because those are the main two things that people know: residential, student. But we're also seeing a huge pull towards holiday lets. I think since COVID, obviously that was a very strange time for everybody around the world, but it kind of gave the holiday let and staycation world a bit of a boom, didn't it? People not being able to leave the country, costs of flights increasing, so people were kind of going away on weekend trips to seaside towns and those kind of places. So Airbnb, holiday lets, very popular now. I think returns, you can get up to upwards of 10% net in some of these projects now at the moment. And I speak to lots of clients who would kind of dipping their toes in that market now, as well as other stuff, the residential stuff and the student, but dipping their toes into that holiday let, short-term let, service accommodation, whatever you want to call it. There's a million names for it, but
but it kind of there just seems to be a different kind of brand under it. But it comes down to the same thing, and I think and that's another kind of great example of how markets evolve without them kind of being pushed in a direction. You know,
Yeah.
When COVID hit, everybody was stayed at home and everybody had to stay in the country, and everybody spent time holidaying here or staying closer to home, doing their home improvements went up, things like that as well. And certainly, out of that, the UK holiday market grew hugely because I think people liked it. And they thought, when you book holiday, you go abroad. And then all of a sudden that was taken away. And then people spent time holiday in the UK, and they're actually like, wow, I can go to Scotland.
You kind of appreciate what you've got, haven't you?
Yeah.
Yeah.
And, you know, and people jumped on the bandwagon with it. And I think you see prices of properties in Cornwall and Devon, I mean, absolutely through the roof on the back of it. Maybe some of the local market weren't too pleased with it because obviously it was pushing prices out of their bracket. But that's part of the parcel, I guess. That's a separate subject, as I say. But yeah, that's one that always comes to mind. And we've moved with, like I say, the short-term lets in places like the Lake District.
Yeah.
Scotland, the lodges.
The lodges, very nice lodges there.
Yeah. Those have been very, very popular. A bit of a similar, smaller scale centre parks type theme. But again, it's something that 20 years ago people didn't even look to. But when you compare that to the not run of the mill, but the everyday traditional stuff, your yields go up, and like you say, you're getting into the 8%, over 10%.
Yeah, and the prices are good as well. There's similar at the lower end. The one you mentioned in Scotland. The price points are similar to student properties at kind of 80, 85k, but you're getting similar returns, 8% net, but slightly different models. So some of those are quite short term, aren't they? Like 5-year rental assurances. Sometimes they'll buy it back off you with a small uplift. Compared to the student stuff where you might keep for 10, 15 years and just get 500, 600, 700 quid a month in your back pocket.
Yeah.
So again, it goes back to, do you want something short term? Do you want something longer? Yeah. So there's plenty of options for everybody, but the market is strong at the moment. It certainly is strong.
Yeah, and I think the first thing we always like to do, as part of our consultancy, is that open conversation to find that out first. Yes. Because I think from doing this a long time, we'd rather you do the speaking, the client explain to us. We then go away and try and find a solution. We never get it right first time, but we try.
You might not.
But it's an elimination process, isn't it? It's a short list, and it's trying to get the right thing that suits. But initially, a bit of discovery about what a client individually wants, I think, is always the best way forward long term, both in building a relationship with the client, but also in understanding what they personally look for.
Yeah.
And I think we haven't come onto the residential market as well. But probably the most established thing that we've done and worked with as a company. Again, let's hit the challenges head on. Mortgages.
Yeah.
Rates are bloody awful.
Rates are awful at the moment. And that's all we heard in the past year, probably, wasn't it?
Yeah. Understandably.
And it's funny you mentioned obviously the whole consultancy side of things. I've spoken to so many people who have gone, I've got X amount of cash, I want to mortgage a property. What have you got? And we've got properties. But I have literally said to them, have you crunched the numbers on what you're actually going to be left with if you buy this property? And with the interest rates where they were, they've dropped a little bit now, but where they were 6 months ago, you're not making anything.
No.
If sometimes you're actually paying someone to live there, it's completely flipped. So people don't quite, and it would have been very easy for me to probably go, I've got a really nice apartment here. Yeah. You can have that.
Yeah.
But we're not here to do that, like you say, just push something on them. But you gotta crunch the numbers, especially with mortgages, like you said.
Yeah. And that'll change again. And it's a journey, isn't it? And rates have been probably too good to be true for a long time. But everything's looking towards potentially the end of the year that reducing. But I haven't got a crystal ball to say that's definitely going to happen. But it looks likely. But yeah, the moment when you're looking at a mortgage payment against what the rental will be, taking off costs, then if it doesn't stack up, it's not an investment worth doing.
No.
And like you said, I've heard you speak to your clients, regarding mortgages, and if the numbers don't stack, we always advise, don't we? Park that idea.
Yeah.
And we'll reapproach it further down the line.
Yeah.
Again, going with that long term, leveraging with the property has worked very, very well. And the residential market is the biggest market still.
Of course.
It always will be.
Of course.
And from what I've seen, probably, I'm sure you'll agree, if you want the appreciation, which again is not something that can be ever put in a contract, a guarantee, but you can look at the markets and, over any 10, 20, 30-year period, UK prices have typically always risen consistently and fairly well.
And even if they drop, they always recover.
Yeah.
So it's a pretty safe bet.
And that's why a lot of the clients overseas, when they speak to us, that's part of the reason they come. It's not a hugely fluctuating market.
Yeah.
You don't maybe get in double digits appreciation in 12 months, but you're going to get consistent growth. And I'll be interested to see if you agree, but I would say that the residential market is the strongest way to purchase a capital appreciation type investment.
Yeah, 100%. I mean, there's nothing that comes close. Obviously, the student stuff, it'll hold its value, but there's no huge capital growth in them. The lodges and things like that, in some cases, they're actually depreciating assets, and you own the land instead, which is an appreciating asset. And the other properties we've got, I mean, we haven't touched on the assisted living properties, which are residential apartments, but with a lease attached, which I'm sure we can touch on in a minute. But so yes, they will appreciate as residential apartments in their own right. But your kind of bog standard city centre apartments, Manchester, Liverpool, major cities like that, especially in the north at the moment, are some of the growth's phenomenal.
Yeah, I can think back to just purely as examples, the Media City towers that we.
Yes.
I mean, I'm going back to probably 2015, something like that. 16. You could buy a 2-bed in there for 145. And at that time, we thought that's not bad.
Yeah,
that's not a bad price.
And now what are they?
Values well mid 200s, mid 300s, that kind of price. People selling pretty quickly at those prices.
Yeah.
And we had some other developments, which actually did prior to that. You could buy a 2-bed for under 100,000 in Manchester. If you go on, you go on Rightmove now, you'd be struggle to get a studio for that price. Yeah. So that's catching the market at the right time. And again, that's probably going to slow a little bit now. But again, it demonstrates over what we've done for our clients over the 20 years. They're clients that bought from us at those kind of prices, and that's the appreciation they've achieved.
What they've seen,
It's mine and your role and the rest of the the consultants we have here to put people into those properties at the right time. And again, if you do it right, and I explained a couple of examples there, you do make fast appreciation.
Yeah.
And and it can be done very well. I know London's not a market that we've got a project there now. We did one in Kent.
Couple. Yeah.
But again, I know I'm fully appreciative that London appreciation is amongst the best in the country when the market's hot as well. We've probably seen it more sat here in Manchester, that probably outside of London over the last 8-10 years, it's been the hottest market to do that. So,
I mean, Manchester's booming, isn't it, at the moment? Manchester really is booming. They can't put them up quick enough. No,
and every time, again, being frank, every time I see a prices, I think, ooh, that's a bit high, isn't it? And then they sell out.
Yeah.
And then I see the price go up, and then the process is repeated. And like I say, I was doing that 8 years ago and seeing things touching over 200. So it ain't going to last forever, but the supply and the demand's there. The big companies keep coming here.
Yes.
BBC, which are close to our offices, ITV, the large banks, you name it. They seem to create a second hub in Manchester, and it's creating a whole new economy, a whole new type of renter. Yeah. And I show clients around that haven't been to Manchester for 8 years. They don't recognise the place.
Yeah.
It's completely...
It's phenomenal, isn't it? The amount of the amount of... I mean, I drive home every day, and you just look around. There's cranes everywhere. There's a new building pops up, or there's a new building that's finished that wasn't finished 2 months ago. I drove past my old place where I used to live in Middlewood Locks.
Yeah, nice development.
Yeah, just across, they've got that little canal across. When I moved out 6-7 months ago, they just started building the 2 new blocks. They're building a whole new project on the other side of the canal.
Yeah.
They're done. They're done. I drove past it. I could not believe my eyes.
Yeah.
It's just phenomenal. The amount of the speed that some of the developers put them up is incredible. It really is.
And also some of the, again, how a market changes is that in Manchester it was having a concierge type service, a gym was seen as, wow, you know, these are pretty nice developments. I mean, the things out there now, you know, they're kind of getting in that London type.
Climbing walls.
Swimming pools.
Yeah, swimming pools, saunas, steams.
Yeah, you know, 4 concierge desks offering a full service as you go inside, underfloor heating, aircon.
Yeah.
I mean, they wouldn't look out of place in Canary Wharf.
No, absolutely not. No.
And people are buying them, and renters are paying. I think we had Lewis in our office, didn't he, who went over to Dubai recently.
Yeah.
He rented his place. Hope he doesn't mind me saying this on here for a couple of grand a month for a one bed in Manchester.
£1,900 a month,
and he paid up front for 12 months.
Yeah.
You know, those kind of rents, again, 8 years ago, if you said that to someone, they would have laughed. But it's a different kind of renter who's going to pay that because of that. You know, that's a very
because
nice
of what you've got around you. You know, and I myself live there now.
Yeah.
And it's just so nice to go home to it.
Yeah.
You know, it's clean, it's tidy, you know, everything's made well, the facilities are great. And yes, it's dear, but you get what you pay for.
Yeah.
And you do what you don't mind paying it if it's nice.
And that's the kind of renter that's out there now, isn't it?
Yeah.
Somebody who has very high disposable income, they're not ready, or not ready for that move, or they're not knowing where they're going to actually settle in life.
Yeah, exactly.
So they're more than happy to pay that premium rent for that kind of quality.
Yeah, and live like that in the interim period of maybe finding the home or the house, you know, and buy something.
When the fun stops. Yeah.
Exactly. Yeah.
Sorry. Yeah. No, that's not a different kind of fun start, should I say?
Exactly.
Yeah,
more wholesome.
That's a much more PC way of putting it. Yeah. So again, I guess we've touched on that. You know, residential, solid on yields. You're still going to get like I said, 4 5s are out there. If you look hard enough, you might get to your 6s, but realistic numbers there. Mm-hmm. But appreciation, getting the timing right in the market. We've done it before for clients. Yeah. We have the know-how to do that again at the right time. And when it's not the right time, we'll say, just hold your horses. I think student market, completely hands-free. You're buying something brand new, be fully managed for you, getting in prices under 100K with that. You're not going to get that appreciation that we've just discussed. And again, it's not something to play around with finance. Because even, like I say, I have clients ring me up, say, got my buy-to-let mortgage, been to Barclays, they've given me a piece of paper, I've got it.
Yeah.
That's fine, but when you go and buy the property, they'll say, sorry, that doesn't suit. So, but if you want to kind of, as an armchair investor, I guess is sometimes how they're phrased, sit back and get that 8 or 10% return, hands-free for 5, even 10 years at Shelton Place.
Now,
perfect.
Yeah,
absolutely perfect.
Yeah.
So I guess we've covered residential, we've covered kind of student, both, like I say, both sides of it, what can suit, what can't suit. And briefly on the kind of the holiday let, the lodges, that kind of thing that we do. And I think one thing, certainly over the last, couple of years, 2-3 years, almost I think about 7 out of 10 clients, they seem to end up purchasing this kind of property is the
assisted living.
The assisted living stuff. Again, I think that out of all of the different developments, the different strategies you have, is probably the one that needs explaining the most, but also what clients get most out of in terms of whether it be income, the way the appreciation works with the yields. But it's slightly more complex. But when actually you break it back down, I'd probably say it's
not that complex.
It's quite simplistic. And when I think a lot of people see the headline of what it is and think A, it's too good to be true, or B, there's a skepticism.
There's a catch.
Yeah, there's a catch to it. And they almost try and find the catch, and there really isn't the catch there. There's a couple of reasons people don't buy them, like anything else. And we'll go into that. But I'll let you sum up. What, 25-year rental contract?
I mean, ultimately, they're just residential apartments, aren't they? Or houses. We've got some freehold houses as well under the same model. And they come with these 25-year rental contracts, don't they? Now, the contracts themselves are actually with a housing association, aren't they, that provide very high-level, specific care to individuals with complex care needs. That can range from... It can actually range from individuals who just need help with their day-to-day activities, cooking, cleaning, washing, things like that, all the way up to kind of individuals with dementia, people who need end-of-life support. So you get a 25-year rental contract with the charity or housing association that look after them, and then they basically collect the rent from the DWP, don't they? The central government here in the UK.
Yeah.
Yeah,
I think there's kind of, the key parties in it are the developer, who will obviously puts the properties together. As you mentioned, the housing association, Yale, which are the carer. Like I said, somebody with anything from post-traumatic stress, end of life, those kind of things. And I guess, sorry, I'll need to come on to that later. And then of course you've got the DWP, which are ultimately paying the rents.
Yeah.
So I think people will really need to understand that that's a collaboration between all three of them. I spent some time with the developer and with Yale as well, Julie, who's oversees it all. And I met some of the tenants. I actually saw, the other side of this, the end of it. I met the various tenants who were in there for their medical reasons, which, as you can appreciate, I can't go into. But, and what they're actually providing is a really good thing. It's somebody who is getting the correct level of care, the right level of care. And it is more complex, that kind of care, to, I guess, someone who needs something like you break your leg, you break your arm. There's a fixed solution to that.
Yeah.
This is
6
something
weeks,
that's mental
6,
or
8
something
weeks
like
you're
that.
done,
And from mental capacity, they're in a much better place. As well as, like I said, there is medical tenants there as well. But the DWP, they're actively involved in the projects from the word go. They come out and assess the development, that it'll meet the criteria of the tenant that's going to go in there, and then they sign off the rents.
Yeah.
So that's all done, isn't it, before one of our properties even comes on the market in that sector. So a lot of people need to understand is there's a lot that goes into them before you see an apartment at Croft Court, or I won't name them all, but that development. So there's a lot of complexity that's already done, signed off, and then you have the opportunity to buy the property with that kind of rental
with the commissioned
return.
rent already in place.
Yeah.
Because it's a rental assurance based on the fact that the rents have been commissioned already by the local council. So they've gone along to the block, like you said, that the developers found or purchased. They've vetted it, had a look around and said, who are you going to be putting in there? Okay, this rent needs to be paid for that specific apartment, for that specific care. That's signed off on.
Yeah.
So the second you complete on that purchase, that income is immediate as an investor. So I think, and you mentioned earlier, clients saying that it's too good to be true, and the amount of people that do say it is probably not surprising, because if someone came to me and said, I've got a property for you, he's going to pay you for the next 25 years, 10% net returns, you don't have to pay any running costs or repair costs, I'd probably go, yeah right, good one. But when something's too good to be true, I always feel like somebody's getting the blunt end of the deal. But like you said, everybody, all parties are kind of winning out of the deal. The government get to save costs on putting people in NHS beds, which costs them, what, £3,000 a week?
Yeah.
The Yale Housing Association are growing, they're helping people. They've got a huge backlog of clients, clients, tenants who need the care. They need the care. It's not kind of they're signing up and excited to start. They actually need the care.
It's a bit like the, I don't know, let's say that you go to hospital and you need some kind of medical operation. It doesn't happen the next day, does it? You go on a referral list and you find out, it could be 12, even quite serious ones you hear about, it's 12 months before I'll have that operation. It's the same with this. When you're referred to assisted living to go and live in one of these apartments, there's a wait list of, when I met the lady from Yale, she was saying that she's looking for at least 2 to 3 premises in Preston because she's got over 600 referrals to literally find accommodation for. So the numbers of tenants required for these developments,
it's huge.
That's why they're trying to expand it quickly. And like you say, they all came. This whole concept it's not dreamt up. This came about from the government seeing that they're paying £3,000 a week, like you touched on, for somebody to be in a hospital bed. And there's a legal duty to look after someone to stay in a hospital bed, but that kind of care doesn't need necessarily to have that hospital bed, and to free that up for somebody who might need something more direct use of that, they can put them into this what rents do they pay? What,
Three-
275,
between
350 a week?
270 up to 350
So-
a week, yeah.
The government are saving a
Yeah,
lot
yeah,
of money
yeah.
in doing this, but when you tot up that rent against what you're buying it at, it is a 10% return. So the ultimate probably winner in terms of cost saving is the government,
Yeah,
because they're saving
of
a huge
course, yeah.
amount on what they'd be paying as alternatives. Even putting someone into like short-term accommodation, that might be like a hotel,
Hotel,
like
bed sit, things like
£200 a
that.
night.
They do, yeah.
It's the cheapest way for them to do it, and they'll cover all your costs as well, won't they? I think
Yeah,
is it
yeah.
what service charge and
It's service charge. Well, it's called a fully repairing and insuring lease, isn't it? An FRI lease, which is quite a common thing, I think, in the commercial world, commercial property
it's
market.
similar to a commercial. Yeah,
So it just means that the housing association cover your service charge, the management fee for them actually managing it for the full 25 years,
yeah.
your ground rent, and any repairs and insurance. I mean, you've got no running costs. You know, that 10% is truly net.
No, and I can think to a friend of mine. He has a couple of buy-to-lets in Liverpool, and he texted me kind of just before Christmas saying, "I've just had a WhatsApp. My washing machine's broke in my one of my apartments, and David, like 2 days before Christmas Day, it's going to cost me £700."
Yeah,
That's part of being a landlord. It happens. That's
part of the parcel.
The
isn't
real part of parcel of being landlord, and it's all those little niggly things which either make people tired or maybe look at alternatives that you don't have with this. That will never happen. It might happen, but A, you'll never pay for it, and B, you'll never hear about it.
Yeah.
Anything from a hole in the roof of the building to, like I said, maintenance to your apartment. Whole 25 years, all those costs covered. And if you think about a 2-bedroom apartment, just as an idea, 200k, 2-bedroom apartment, service charge on one of those, 1,500, let's say, per annum. Over the 25 years, you're talking what?
It's going to go up.
30 odd grand, aren't you? Just in service charge that you'd normally pay.
Yeah.
That's 30. So straight away, you're writing off £30,000 worth of service charge payments because they're going to be paid for you. Management fees, 8 or 10% per annum, all covered and paid for you. Ground rents, if it has it, we can touch on ground rents, another discussion.
350 quid, let's call it.
Hold on. So all those costs, boom, put to one side,
Yeah.
just a net income return coming in.
Mm-hmm.
Again, well, that's all the rosy stuff. There's a couple of reasons people don't buy them, and I guess one thing to touch on, which is the finance side of things.
Exactly, yeah. So they are full cash purchases, which
Not for everyone.
is a limitation. It is a limitation. Not everybody's got. I think we've got some starting at 140k. Not everyone's got 140k lying around.
No.
So that is a limitation. Obviously, if you do, and actually, just off the back of that, even if you do, some people don't want to put all that money into one property.
I agree.
You might have 300 grand. If you spend 150 of it just in one property, lots of people go, well, I could buy 3 properties with 150k.
Yeah.
So why would I do that?
And again, that's different investment model. Like I said, there's not one shoe that fits all.
Yeah.
I think if you, again, and that's only probably because of challenging mortgage rates right now. Because I get a lot of clients saying that, I'd rather spread that 50, instead of 150 on one, let's put 50k down on 3. When you put that mortgage payment down on your calculations for each one against what the rents are, and you buy one of these outright for 150, the return is way higher. Yeah. Like 3-4% higher. Yeah. It's miles higher. So maybe at the right time that would change, but one property, you own it outright, all your costs covered, then leverage it against 3. In today's market, you'd always go for that one.
Yeah. And if you are in a situation where you wanted to kind of test the waters with one, you're not tied in for 25 years.
No.
You can sell after 3 years. Obviously due to the option agreement written into the contracts, which I'm sure we can touch on. But lots of people say, I'm 70 years old, Henry. I was 60 years old. I might not see another 25 years. Well, you can sell. You can sell, and you'll always sell it for more than you bought it for, with that lease attached to it, because the rents increase, don't they? So you get an annual increase in line with inflation. So that 10% is going to turn into 11, 12, 13 over the years.
Yeah.
So if you sell it 10 years down the line with a 15-year rental assurance on it at 10% again, you're always going to sell it for more than you bought it for. So
of course you will.
It's still very flexible, even though you have put all cash into it. It's still quite flexible from a sense of if you need that cash back, resale value, you've still got options.
Yeah, because a lot of clients say, all right, that's great if I could sell it in year 10 or year 15, but will it sell quickly?
Mm.
Well, you kind of answered the question there yourself. If you put your property on Rightmove next to all standard tenancies are 12 months, aren't they? 6, 12 months, mostly 12 months. Yours goes on with 15 years left on the contract.
Yeah.
Which one for and the return is 10%, and typically
yeah.
residential, even student we touched on, might get to 10, but it's 8. But it's a higher yield and it's got a way more secure setup.
Yeah.
So the resale market of that kind of property, and then sometimes I bring them back to, well, you know, why are you looking at this? You're looking at it for the same reason that someone in 10 years' time would look at it with 15 years left on it. It's long, you know, it's long-term security.
It's a long time, yeah.
And I think out of every market that we cover, it's the one where I would most encourage someone to speak to us.
Yes.
Even if it rules it out, even if it says, thank you for your time.
It's not
what I thought it was, but it's not for me.
Yeah.
But don't let them undiscovered questions that you have not be answered, because a lot of it, and we both know this, it's very different to how people perceive it for the kind of the reasons we touched on. So an open conversation about that is probably the most valuable about any other market. And not just with me or with Henry, with anybody here at Knox, that would be probably the most valuable conversation.
Yeah, no, 100%.
If as much, to rule it out.
Yeah, 100%. And because there are lots of nuances, you know, there are lots of complexities to it on the face of it. But as you mentioned earlier, once you actually, which we just have, kind of explain it and go through that, it's not that complex.
No.
It's really not.
No.
And the risk involved is minimal, even though lots of people think it's very high.
It's minimal.
It's very, very minimal. Given the accreditation that Yale has, you know, they're a CBS registered charity.
Yeah.
That's almost impossible to get within the care industry. Obviously, that accreditation being in place allows them to command such high rents from the DWP.
The central government,
So the setup is very well established, and it's not actually that new. Lots of people go, oh, well, it's brand new.
Yeah, they think they're buying the first development.
Yeah. You know, it's a bit rocky, but we've been selling the 25-year contracts for a number of years, but you could just buy them as entire blocks, couldn't you?
That's right.
Not individual apartments.
That's right.
So hence why now the influx of people buying them is because we've fractionalized the sale of them, if you like. So,
and I think it speaks volumes already. You know, somebody looking at this and maybe, understandably, until you know anything, it doesn't have to be property, until you understand it, you're either skeptical about it or you rule it out for whatever reason. The people who've been buying these kind of properties from us and generally out there in the market, investment funds, large
funds,
London investment funds, I won't name them, but large investment funds are buying blocks. We're talking tens of millions of pounds. They've gone through the process just like somebody first approaching us. They're but a bit more complex when it's of that scale. But again, it's something that they've. I mean, you can imagine the red tape for an investment fund to approve something of that level.
Yeah.
Gone through it with a fine-tooth comb, and that's something that they repeat purchase in blocks.
And there's very, very small margin for error with kind of institutional investors. So that gives you a little bit of reassurance on the security of the contract and then the investment.
Because they're buying the property. The contract looks the same as you or I buying it. But again, they've used lawyers, lawyers involved in any property purchase, just like these. And they've gone through that process, legal process, and like I said, they're through to completion on a number of blocks, as well as we've had high net worth guys and people like that buying in multiples at the same time. So it's new to people, but like I said, there's large organisations.
Yeah, it's a proven model.
Out there in the market for a good number of years. Again, maybe touching on, I had a guy last week who chose not to get one. And his reason was something that was right for him. He said, I'm not comfortable buying a property that I can never live in. He said, I know I don't live on its doorstep, but anything can be, I know no circumstances, but he thought in 5 or 10 years' time, I own that property, I bought that property, I can't move into it, I'm handing it over for 25 years.
Right.
Interesting. I get that, if that again, and that's something to think about. This property, yes, you own it. Yes, I'll touch on something else in a minute, but so you've got to be comfortable with the fact you're handing it over at the same time as taking ownership. You're handing it over on a rental scale for 25 years, unless you sell it earlier than that.
It's for the income.
Yeah,
that is literally it. It is just for the income.
Yeah.
You know, it's for that month in, month out, money in your back pocket, good return, security for 25 years, there's no cost to pay. That's what it's for.
Yeah.
And obviously, if you're in a position to kind of lock that kind of capital away initially, but like I said, you can sell after 3 years. So
yeah, you can. And I guess one thing that people think, again, I'm just questions coming in my head, is that they think that, and it's probably because of the terminology of a lease, it comes with a 25-year rental lease. They think that you're leasing the property for 25 years. And again, that's why I do encourage people to come and talk to us about these, is that it's same as you or I buying our own home. It's exactly the same. It's just the rental contract that's for 25 years. So, anybody listening today, or as I advise any client, it's the rental contract's 25 years. It's full ownership.
Yeah, you own it, you get the title deeds. There's no difference to buying a property. Not like you said, your own property or anything like that.
You own it outright for that period. I think, again, people see that 25 years and think, well, so after 25 years, it's taken back from me. Where there may have been schemes like that. It's not something we've ever worked with, but it's full ownership, and it's that 25-year rental. And I think you probably be good for you to touch on the how that clause works.
Oh, the 3-year clause.
Yeah.
So obviously, like I said earlier, lots of clients, or not lots, but clients do ask or are concerned that they're tied in for 25 years, which they're not. You are tied in for the first 3 years, and that is just because the developer writes in an option agreement or an exit clause, whatever you want to call it, whereby he can potentially sell the entire freehold site on to typically one of these institutional investors, which you mentioned earlier. If they do, you basically get all of your initial money back, plus a guaranteed uplift of 30% as a minimum. And then obviously everything above that is split 50-50 between you and the developer. But it's a substantial uplift, which you can either look to buy another one, do it again, or invest in something else, go on holiday, do whatever you want with that money. But if it's not triggered in that 3 years, your 25 years carries on, the ball's in your court, sell whenever you like, keep it, you do have autonomy over it.
Yeah, and when you put it together, because that kind of situation isn't going to be an imminent thing, and equally it's not in stone either, is it?
No.
But I guess I was trying to think back to kind of the reality type situation, that if you didn't purchase one of these, but you went out and bought your normal buy-to-let in any of wherever you live, whatever part of the country, and then somebody, as you were purchasing it, somebody said, I'd be interested in buying that back off you at 30% more than what you're just about to pay for it in the next 3 years. Yes, thank you. Yes, okay.
Where do I sign?
Because anything over 30%, then I'll split the profit. Okay, that's the reality of it. It's no different. It's no different.
It's not.
And like say, so let's say it happens in year 3, just before year 3. So you've owned it for near enough 3 years. You've had 10% income for, let's say, 3 of them. All right, 30% income. You got 30% uplift on the price, 60% return on investment in 3 years.
I'll take that.
I would take that all day long. I mean that when you again, if you spoke to somebody with that phrase first, I can get you a 6% return on something in 3 years. Yeah, of course you can. But when you break it down into how that looks and how it works, and again, it's nothing that's set in stone. It's just something else that's in the contract. There is an option there of walking away with that kind of return. Yeah. But the reality of it is investment funds will only buy them as blocks.
Yeah.
And usually once they're up and running for X amount of years or for various reasons. So, but they will come in at that point and they could look at a development and it still looks fruitful at that price.
Yeah, yeah.
And I would expect from my conversations with clients, if that did happen, they'd walk away with a 30% and just put the money into another one.
Yeah, yeah.
Because you can do.
What have you got to lose? Either it happens again.
Yeah.
Or you get another 25 years of security and income.
Yeah. There's two sides of it. Either get a short, let's say it happens after 3 years and you get 60%.
Yeah.
Let's go to the other end of the scale, that for 25 years you keep it. I think on some of these properties, the 2 beds, you're earning over £600,000 in rental income because, as you say, that the rent increase is a minimum of 1%, maximum 5% per year, depending on the CPI index. And when we often send out to clients a breakdown of how that 25 years looks.
On average of 2%, we say, as a projection.
Yeah, which is conservative.
Which is very conservative.
Yeah, I think the CPI index over the last 10 years depending on who's put those stats together, but it's about 2.4%, 2.6% last 20 years. So we always work to conservative figures. On 2%, yeah.
So it's 600k, isn't it?
Yeah, and again,
200 grand property.
Somebody said to me, I've got to keep repeating myself, don't I? But if somebody said to me, and I was buying one of my normal buy-to-lets, Adam, I'd like to rent your property for 25 years, and I'll also pay you an increased rent every year for the next 25 years.
Oh, go on then.
I'd be getting the champagne and chocolates out. That's what I'd be doing. I'd be saying,
absolutely.
sign there, have a drink of that, and I'd walk away smiling.
Yeah.
And it's no different.
No, it's not.
It's a legal contract to say that. So, and for all the reasons that we mentioned, the structure behind it, the reason the government are saving costs, the reason it's long-term care. You know, a medical tenant might live in it, end of your life. There's no length on that, but it's somebody with a post-traumatic stress, something like that.
Yeah.
They could live there for 20 years.
Yeah.
They could.
Some of them aren't seeing the end of their life out in those properties.
Yeah.
You know, and they've got secured tenancy. You know, they have what's called a secured tenancy. So they're almost exempt from being evicted. You know, if anything were to.
This is a key point.
If any, and it's probably a good one to touch on. You know, lots of clients go, well, what happens if Yale disappear?
Yeah.
Or go into administration or cease trading. Well, I mean, there's lots of points, and I'm sure you've got some great points on that. But firstly, as I mentioned, they've got secured tenancies. So if something were to happen to Yale and they couldn't provide the care anymore, they can't just kick these tenants out. You know, they can't just go, right, that housing association's gone, you're going to have to go as well.
That's right.
They have to move a new housing association in. The rents are already commissioned at that certain level for the building and the apartments, and for those people to receive that level of care.
That's right.
So you will get almost a new contract drawn up with the new housing association, and they'll honour the remainder of that contract.
So like you said, but it's an upfront question, isn't it? What happens if Yale, went out of business for any reason or something along those lines? What happens to me? Yeah, once to the tenant. Well, like I said, there's a legal duty of care to look after that tenant. And again, it's something that's thought about before any of these projects come to the market. And with that, in terms of Myashon are kind of there to kind of step in, because the other alternatives, if Yale ever failed, then they would have to take every tenant out of each property, put them back in a hospital bed, put them back in a hotel. All of a sudden, they're £350 a week. They put 10 in hospital beds. That's 30 grand for 10 of them. Other people going into different accommodations. So they've thought about that before. About, should there any situation arise, it's been thought about, and it's been, a process is already put in place to protect the tenant ultimately, because the government, they're not doing it to protect ultimately the investor, but the protection that comes to the tenant protects the investor at the same time.
Yeah. So, and that's always a good thing to touch on as well, because you have to touch on worst case scenarios.
Yeah.
What's absolute nightmare worst case scenario, Adam? If this goes wrong, where's my 200 grand gone? You're covered.
Yeah,
you are.
Yeah, and you're covered because there's a legal duty of care to that tenant, which equally kind of their protection is your protection. Because, like I say, that person has to be, same as somebody in a hospital bed. You can't really be chucked out of a hospital bed unless you are asked to leave. There's that legal duty of care whilst you're always under that supervision by Yale or wherever the housing association is. So, like I say, it's an upfront question. We say, if Yale ever did stop as a company for any XYZ reason, then it's already in place that Myashon would come in and somebody else would see out the 25-year contract. So it just seamlessly continues that way.
Yeah. It's in everybody's best interest to do that and keep that tenant exactly where they are and honour the remainder of that contract, basically.
I think
that's pretty much. I think we've covered quite a lot there, haven't we?
Yeah.
But,
no, it's been good.
It's been great, and thanks for joining us.
Yeah.
It's nice to have a chat.
Yeah.
Obviously, we share the office, but we don't get to chat too much in this kind of detail and day to day, do we? So
no. I think I might get this from my house.
Yeah, it's nice, isn't it?
Nice,
it's
nice.
Well, I might get one of these actually.
Very, very dapper. But it's great, and I hope for people listen for different reasons. I hope they got something out of it.
Yes, that's the main thing. And obviously, if anybody's got any questions and wants to chat to either Adam or myself or any of the consultants here, then
open conversation.
We're more than happy to do that all over again, aren't we?
I'll have a cup of tea first.
Yeah, a cup of tea.
All right, thank you.
Brilliant.
Cheers.
Thanks.
I hope you got something, however large or small, out of this content. I hope something's been very useful. Please like and subscribe for the next further content.
If you enjoyed this video, why not check out our similar video just here.